Welcome back to the deep dive. Today we're doing something a little dangerous.
A little.
Okay, maybe very dangerous. We're taking a sledgehammer to the most sensitive, most volatile, and I think most critical part of any business operation.
The pricing model.
The pricing model. And I don't just mean we're talking about inflation or, some high-level marketing strategy.
Yeah,
No.
right.
We are looking at the invisible digital architecture that decides, down to the very last penny, what a customer pays the split second they hit checkout.
Dangerous is absolutely the right word. In the SAP world, if you mess up, say, a shipping label, a package arrives a day late.
Right, it's an annoyance.
It's annoying, sure. If you mess up a production order, maybe you have a bit too much inventory. But if you mess up pricing,
Oh, that's immediate.
it's immediate. You are impacting revenue, margin, and legal compliance instantly. It is, hands down, the quickest way to get fired as a consultant.
Wow. Okay, so that sets the stakes pretty high. We are working today from a stack of what are labeled expert level notes, and they're specifically for an SAP sales and distribution or SD consultant.
Right.
But we aren't talking about routine maintenance here. This isn't a junior analyst just updating a spreadsheet. The whole scenario in the source material is a complicated change request. The client has basically come to you, the consultant, and said, our pricing is broken. It's too generic. We need you to blow it up and rebuild it from the ground up.
Which is, it's music to a senior consultant's ears because it's a real challenge.
It's a meaty project.
It is, but it's also a complete nightmare scenario if you don't know exactly what you're doing.
Yeah.
The notes, they call this an architectural redesign.
And that word choice feels important.
That distinction is vital. This is not table maintenance. We aren't just, changing the price of a gallon of milk from $2 to $3.
Because of inflation or whatever.
Exactly. We are changing the logic of how the system decides that milk costs $3 in the first place. Is it because of the region? The season? The customer's loyalty tier? We are literally rewriting the rules of reality for this business.
So before we dive into the nuts and bolts, or I guess the tables and keys, the notes outline 3 really clear, non-negotiable objectives for this redesign.
The guiding stars, yeah.
They seem to be. If we miss these, the project fails, no matter how clean the code is. First up is scalability.
Right. And that's so important because the one-price-fits-all model, which is what the client is desperately trying to escape, it's rigid, it's brittle.
It breaks easily.
It breaks easily.
Yeah.
If the business decides, say, next year to open a new web store, or maybe they acquire a competitor in a different country, you don't want to have to rebuild the entire pricing engine from scratch.
You want to add a room to the house, not bulldoze the whole thing?
That's a perfect analogy. You build a house where you can easily add a room, not one you have to destroy just to put in a new window. Scalability means the system can grow with the business, not hold it back.
Okay, that makes sense. The second objective is accuracy. And this feels, it feels obvious, but the notes really stress zero tolerance.
Because there is no close enough in pricing. There just isn't. It's binary.
It's either right or it's wrong.
It is either right to the penny or it is wrong. And if it's wrong, you are either bleeding margin giving things away too cheap, or you are overcharging your biggest clients.
And destroying relationships.
Damaging relationships that took years and years to build. You can't just fix it in post-production. It has to be right at the moment of order entry.
And the third one, which I think is probably overlooked by people who aren't in this world, is traceability.
Oh, hugely important. Just imagine this. A sales rep is on the phone with a customer. A price pops up on their screen. Let's say it's $95.
Okay.
And the customer asks, wait, hang on, I thought I got a 10% discount. The rep needs to be able to know why the price is $95.
Was it a promo, a volume discount?
A glitch. Exactly. All of those. If the system is just a black box that spits out a number with no audit trail, the support team is completely helpless. So we have to build a system that shows its work, just like we all had to do in math class.
Okay, so the mission is clear. We're moving from a static, flat model to something dynamic, multidimensional. The notes say we have to base this new pricing on 2 critical factors, the who and the how.
Precisely. Right now, the client just says widget A is $10. That's the old world. It's obsolete.
Flat.
Totally flat. We need to get to a state where the system can say widget A is $10 unless you are a gold partner. That's the who buying through the wholesale channel. That's the how, in which case the price is totally different. It's all about context.
So let's get into that blueprint then. Section 1 of our deep dive is dissecting the requirements. In SAP, we talk about keys. These are the triggers, right?
They're the variables, the inputs, yeah.
Yeah. If we want this dynamic pricing, we have to tell the system what variables to even look at. Let's run through these because they feel like the vocabulary for the entire project. The first one is VKORG.
Sales organization. This is the absolute highest level. It represents the legal corporate entity that's making the sale.
So this is like the passport of the transaction.
That's a great way to think of it. Is this sale happening as US Inc. or Germany GmbH? Every single price lookup has to start here because your tax laws, your currency, your general ledger accounts, all of that depends on the sales org. You literally can't price anything until you know who is doing the selling.
Okay, top of the pyramid. Next up, VTWG.
Distribution channel. This is the how. And for this specific client in our deep dive, this is the big transformative shift.
This is what they're paying for.
This is a huge part of it, yes. Are we selling via wholesale, retail, e-commerce, direct sales? This matters immensely because a wholesale buyer who's purchasing 10,000 units expects and gets a completely different base price than someone walking into a showroom to buy one. The channel dictates the market strategy.
Then we have SPART.
Division. So that's your product line. Think electronics versus apparel, for example.
So different parts of the same company.
Right. And usually this is used for things like reporting or defining profit centers. But sometimes you really do have different pricing strategies for different product lines. Maybe your electronics division has paper-thin margins and really strict pricing, while apparel has these high markups and much more flexible discounting. SPART lets you separate those rules.
Got it. Now we get to the specific actors in the play. QUNNR.
The customer number, this is for your VIPs, your big accounts. If you have a legally binding negotiated contract with a massive retailer, let's just call them Megacorp, their unique ID, their QNNR, is the key that unlocks their specific price. It's designed to override almost everything else.
But you can't possibly make a specific record for every single customer, can you? I mean, if you have 50,000 customers, managing 50,000 individual price records would be a nightmare.
No, a complete nightmare.
Yeah.
It's totally unmanageable, and it's definitely not scalable. So use Condia, customer price group. You bucket the smaller fish. You create these tags like gold tier, silver tier, or maybe education sector or government.
So you group them by behavior or type.
Exactly. You set the price for the group, and then everyone with that tag on their customer master record automatically inherits that price. It's so much more efficient.
And finally, the most obvious one, MATNR.
The material itself, the product code. You can't price nothing.
So those are all our variables, our inputs. Now, what are we actually calculating? The notes break this down into three main buckets we have to redesign: base price, discounts, and taxes.
These are the fundamental building blocks of what we call the net value. You have your base price, that's PR00 in SAP speak, which is the gross sticker price.
The starting point.
It's the starting point. Then you have your discounts, things like K007 or K00, which are, of course, deductions. And finally, you have taxes, MWST, which is the government's cut.
And the challenge here is that all three of these need to be dynamic all at the same time.
At the same time. They all have to resolve in milliseconds to give you that final, accurate, bottom line number on the order.
Okay, so to do that, we have to understand the machine that processes all of this. This brings us to section 2, the engine room. The notes introduce something called the condition technique.
And I'll say this right now. If you are an SAP consultant and you don't grasp the condition technique intuitively, I mean, if you don't dream about it, you just cannot do this job.
It's that fundamental.
It is the algorithm that runs the search. It is the brain of the entire pricing operation.
The notes use a 4-pillar analogy to explain this, which I think is helpful. I want to walk through these because it really helps demystify that black box we talked about. Pillar 1 is the condition table.
Okay, so think of a condition table as a very specific question you are asking the database. Each table is defined by a key combination, which acts like the index in a library.
So it's not the data itself, it's the structure for the data.
It's the structure, it's the question. So let's say table 304. That might represent the question. Do we have a price for this specific material inside this specific distribution channel? It's a very targeted database lookup. If material is X and channel is Y, what is the value?
Okay, so that's the table, the question. Pillar 2 is the access sequence.
This is the strategy. This is the intelligence. The access sequence is the prioritized search list. It tells the system which questions to ask, which tables to look in, and critically, in what order.
The order matters.
The order is everything. You generally want to search from the most specific to the most general. So step 1, or access 10, might be, do we have a special price for this one specific customer and this material?
The megacore price.
The megacore price. If the answer is no, it moves to step 2, access 20. Okay, well, do we have a price for this customer's group? Still, no. It moves to step 3. Fine. Do we have a standard price for this channel?
So it's a cascading checklist. It just keeps falling down the ladder until it hits a rung that has data on it.
That's a perfect description. It's a ladder.
Yeah.
And it stops, or it continues, based on what it finds at each rung. It manages the whole hierarchy of logic for us.
Okay, that makes sense. Pillar 3, condition type.
This is simpler. Just defines the nature of the money. Is peer 00 the price? Yes. Is key 0000 a discount? Yes. Is MWST a tax? Yes. The condition type also controls the behavior. Is it a percentage? Is it a fixed dollar amount?
Or can a sales rep change it manually?
Exactly. Can it be changed manually, or is it locked down? Is it a surcharge, adding money, or a deduction, taking away? All that is a condition type.
And the 4th and final pillar, the pricing procedure.
The calculation scheme. And this is basically the math formula. It's the layout of the receipt. It says take PR00, then subtract K007, then add MWST, and put the final result in the net value bucket. It stacks all the blocks in the right order.
So you don't accidentally calculate the tax before you've applied the discount.
Exactly. That would be a very expensive mistake.
Yeah.
The procedure ensures the math is done correctly, step by step.
So just to summarize and make sure I have this, the procedure is the overall receipt layout.
Yep.
The condition type is the description on each line item, like base price or discount.
Correct.
The access sequence is the smart logic the system uses to find the value for that line item.
And search strategy.
And the condition table is the actual drawer in the filing cabinet where that piece of data lives.
That is a perfect summary. You're ready to start configuring.
I am definitely not. We have to design the logic first. Section 3 is designing base prices. And the problem that the notes identify here is that tension between specificity versus generality. We need a hierarchy.
We need to funnel the logic. You always want to start narrow, then go wide. The notes suggest a very standard 4-level funnel for the base price, for PR00. This is best practice.
Let's walk through it. Level 1, the highest priority in that access sequence.
Specific customer plus a specific material. This is your negotiated contract. If you have a signed contract with Megacore that says they get widget A for $50, that overrides everything. The system has to check for this first. If it finds a record, we want it to use it and stop.
Level 2, if you're not Megacorp.
Customer group plus material. So if you aren't Megacorp, but you are a gold partner, you get the gold partner price for that material. This is a bit broader, but it's still very targeted.
Level 3, this is the big new requirement from the client in our scenario.
Distribution channel plus material. This is key. If you're not a special customer and you're not in a special group, we then look at how you are buying.
Wholesale versus retail.
Exactly. Wholesale gets one price list, retail gets another. This becomes the standard list price for that specific market segment.
And level 4, this is the safety net at the very bottom of the funnel.
Material only. The global base price. If you fall through all the other filters, you're a brand new customer buying through a new channel, no special deal in place. The widget costs $100. This is crucial because it ensures the item never ever comes up with a price of 0.
Okay, now here is where it gets really technical and I think really interesting. The notes mention a specific setting in the configuration transaction V07, and it's something called the exclusive indicator. It's just a checkbox.
Ah, yes. The tiny little checkbox that can cause millions of dollars in headaches. It might just be the most expensive pixel on the entire screen if you get it wrong.
So explain that. Why is it so dangerous?
Okay, remember the search strategy, the ladder. The access sequence goes from step 10 to 20 to 30 and so on.
Right.
The exclusive indicator, that checkbox, tells the system, if you find a valid record at level 10, SAPSDTOP50 searching, you're done.
Which seems logical. If I find the special Megacorp price of $50, I don't care that the global price is $100.
You would think so. And that's exactly right. But what happens if you, the consultant, forget to check that box? The system finds the Megacorp price of $50. Great. But because it's not marked as exclusive, it keeps looking. It continues down the ladder to the next step. Eventually, it finds the global price of $100.
So what does it do? Add them together?
Depending on your procedure, it might add them together to make $150, which is obviously wrong.
No.
Or, more commonly, it might simply overwrite the special price with a generic one, because the generic one was the last one it found.
So you could accidentally charge your best, most important customer the standard retail rate, effectively ignoring their contract, all because of one missing checkbox.
I have seen it happen.
Right?
A client goes live, and suddenly their biggest distributor is on the phone screaming because they're being charged retail prices. The consultant just assumed the system knows to stop.
It doesn't?
You have to tell it. That exclusive flag is your way of saying, I found what I was looking for. We're done here.
Wow. The notes give a practical example of setting this up after the fact in transaction VK11. That's the maintenance screen.
Right. Once the logic, the architecture is built, you have to feed it the actual data. So a business user would go into VK11 and create a record for distribution channel 01 wholesale, where the material is $80.
Okay.
Then they create a completely separate record for channel 02 retail, where the same material is $120. And because you've set up that access sequence correctly with the exclusive flag, the system just translated, it automatically picks the right one based on how the order is entered. No thinking, no manual selection required.
That seamlessness leads us right into Section 4, the Wild West of discounts. And I'm calling it the Wild West because, unlike base prices, discounts don't always want to replace each other.
That's a great way to put it. Base prices are usually mutually exclusive. You pay either $100 or $90. You don't pay both.
Right.
Discounts, however, play by totally different rules. They can be cumulative, meaning they stack on top of each other, or they can be best price, meaning you get the single best offer that's available to you, but only one.
The notes break this down with a Scenario A and a Scenario B. Scenario A is a customer-specific discount using condition type K007.
That's your standard relationship-based discount. Megacorp gets 5% off everything on every order just because they are Megacorp. It's usually a fixed percentage tied to their master record. It's predictable.
And Scenario B is a channel-specific promotion using a different condition type, KA00.
Right. Think of that as a sales deal, a marketing campaign. Summer promo. Get 10% off for all wholesale orders placed in July. This is temporary tactical pricing.
Okay, so here comes the conflict, the what-if scenario. A buyer from Megacorp places a wholesale order during the summer sale in July.
Right.
They qualify for their permanent 5% partner discount and the temporary 10% summer promo. What happens?
Well, that depends entirely on the business strategy. And our job as the consultant is to make the system match that strategy. Does the client want to give them 15% off?
That's stacking.
That's stacking. It's great for the customer, but maybe not so great for the company's margins. Or does the client want to give them just the 10% discount because it's the better of the two deals? That's best price.
And the system can handle that logic. It can compare them.
It can. The notes mention a specific tool for solving this exact conflict: condition exclusion groups.
Okay, tell me about those.
This is how you configure that best price logic. You go into a transaction, OV31. You create what's called an exclusion group. Let's just call it Z001. Then you put both of those discount types, the customer discount K007 and the promo discount KA00, into that group, into that basket.
So you've identified them as competitors.
You've told the system they are related and they can't coexist. Then you assign a rule to that basket. You can choose logic A, for example, which means best condition between condition types.
So the system does the math for both behind the scenes.
Exactly. It calculates both options in the background. It looks at the final dollar values, and it only applies the one that gives the customer the biggest savings. It automatically finds and suppresses the other one.
That's brilliant. I love that the system can do that. But there's a warning here in the expert note. It says, best price logic is a massive source of post-go-live disputes if not clarified early. Why is that?
Because customers do the math too. And if they think they're entitled to both discounts, look, I have a contract that says I get 5% and I see a big banner on your website for 10% off, they naturally assume they get 15%.
Of course.
So when the final invoice arrives and it's only 10% off, they feel cheated. They pick up the phone and call customer service. And technically, the system worked perfectly. It gave them the best single price. But psychologically, the customer feels like a benefit was taken away from them.
So the technology is working, but the business communication has failed.
Precisely. This is something that needs to be clarified up front in the contract or on the promotional material. You can't fix a communication problem with ABAP code.
That makes a lot of sense. All right, let's move on to Section 5, the tax trap.
Ah, taxes. Everyone's favorite subject. The most complex part of even the simplest transaction.
The notes are clear that taxes aren't just a flat rate you plug in somewhere. They're just as dynamic as everything else. And there are 3 keys for MWST, which is the standard tax condition. It feels like a triangulation is happening.
It is a triangulation. To get the tax calculation right, you need 3 pieces of geography and logic all working together. First, the departure country. Where is the plant? Where are the goods physically shipping from?
Okay, starting point. Second is the destination country.
Where is the ship to party located? Where is the product actually going? This relationship between departure and destination determines the cross-border logic. If I ship from New York to New Jersey, that's domestic sales tax. If I ship from New York to Germany, that's an export, and it's usually tax exempt. The system has to know the route.
Okay, so from and to. What's the third key?
Tax classification. This is the subtle one, because even if the road itself is taxable, let's say U.S. to U.S., you have to ask, is the customer liable to pay tax? Are they a government entity, a church, a nonprofit?
And what about the product?
And is the material itself taxable? Some goods, like certain foods or medical supplies, might have reduced tax rates or be completely exempt.
The notes really emphasize master data governance here. They talk about the importance of simple 0 versus 1 flags.
This is where the configuration meets the real world, the actual data. In the customer master record, transaction XD02, there's a field for tax classification. You set it to 0 if they are tax exempt. You set it to 1 if they are fully liable.
And the same for the material.
The same thing exists in the material master, MMLO2.
So how does the system use these little flags? It's not like it has a rule for every customer.
No, it uses a truth table, a combination. You don't set a tax rate for every single customer. That would be impossible. You set a rate for the scenario. So you create a record in the system that says, if the departure country is U.S., and the destination country is U.S., and the customer's tax class is 1, liable, and the materials tax class is 1, full tax, then the rate is 10%.
And if that customer class flag was set to 0,
then you would have a different record that the system would find. It would say, if departure is U.S., destination is U.S., and customer class is 0, then the rate is 0%. The system just matches the combination of those variables to find the right rate.
so if your master data team forgets to set the flag to 0 for a new charity you're selling to, the system will, by default, charge them tax.
Exactly. And then you have an angry phone call, a credit memo request, and an annoyed accountant. The configuration is only ever as good as the data that's entered into it.
Okay, we've covered the basics: base price, discounts, taxes. But Section 6 takes us into advanced logic. This is for when the standard tools aren't quite enough. The notes bring up VOFM routines. What on earth is a VOFM routine?
So standard configuration, all those tables and access sequences, is incredibly powerful, but it's somewhat static. Sometimes you need very specific logical checks that simple checkboxes can't handle.
Like an I-then statement that's more complex.
Exactly. VOFM routines are small snippets of ADAB code, that's programming code, that you can attach to your pricing procedure. They act as little gatekeepers or traffic cops.
The notes highlight routine 2, called item with pricing.
This is a classic safeguard. It simply ensures the pricing engine only runs if the item is actually relevant for pricing. Imagine a sales order. Line 10 is a widget. Line 20 is a text note that says, please deliver to the back door. Line 30 might be a free brochure you're including. You don't want the pricing engine to waste time trying to calculate a price for the text note. It'll just error out because there's no material master. Routine 2 checks the item's category and says, nope, this is text, skip it. Do not trigger pricing for this line.
And what about routine 10, plant set?
This one is used all the time for taxes. Remember we said tax depends on the departure country.
Which comes from the plant.
Which comes from the plant. But in SAP, a user can enter a material on the sales order before they've selected the shipping plan. If the tax engine tries to run before that plan is determined, it looks for a departure country, finds nothing, and it either crashes or gives the user a scary, missing tax indicator error.
So what does routine 10 do?
It just acts as a pause button. It tells the system, stop. Do not attempt to calculate tax until the plant field is populated with a value. As soon as the user selects the plant, the routine opens the gate, and the tax calculates perfectly. It just prevents the user from seeing error messages while they're still entering data.
That's really smart. It prevents the system from guessing or failing too early. The notes also mention group conditions in this advanced section. This seems to address that classic total order value discount.
Right. This is a request you get on almost every project. If the total order is over $1,000, I want to get 5% off everything. The problem is standard SAP pricing calculates line by line in isolation.
Item A is $50. Item B is $50. Neither is over $1,000.
Exactly. The lines don't know about each other, so the discount would never trigger.
So how do you make it look at the total?
In the configuration for the condition type, in transaction V06, you mark it as a group condition. It's another one of those powerful little checkboxes. This tells the system, before you even think about calculating this discount, first sum up the value of all the items in the order header. It looks at the total cart value to determine if the threshold is met, and if it is, it then trickles that 5% discount down to each of the individual relevant items.
That is such a crucial distinction, header-level logic versus item-level logic.
It is. Without that one setting, the customer would literally never trigger the discount because no single item on its own is expensive enough.
Okay, so we have built the machine. We've handled the advanced exceptions. Now, Section 7, the safety net. Testing and troubleshooting. The host note here is really emphatic. You cannot simply change pricing and hope for the best.
Absolutely not. You just can't. This is revenue.
Yeah.
You need a rigorous, methodical testing strategy. You need to try to break it in every way you can think of before a real customer does.
The notes suggest a few unit testing scenarios. Let's run through them. First, the simple channel check.
Simple enough. You create a sales order in channel 01, wholesale. You check the price. Then you create an identical order for the same product, but in channel 02, retail. You check the price again. They absolutely must be different.
And if they're the same?
If they're the same, your access sequence is wrong, or more likely you forgot to load the data for one of the channels.
Okay. Second test, the exclusion check.
You have to create that exact scenario we talked about earlier. Find a customer who qualifies for both the Gold Partner discount and the temporary channel promo. Create an order. Does the system do what the client wanted?
Does it pick the best one? Or does it stack them?
Exactly. You have to verify the math. Don't just assume the exclusion group is working. You have to prove it with a real test case.
Now, we move on to regression testing. This is all about making sure you don't break old stuff while building new stuff. The notes mention old orders.
This is so vital. You have orders in the system that were created 6 months ago. Maybe they're still open, waiting for stock to arrive. If I open that old order today, after the new pricing logic is live, does it automatically update itself to the new higher price?
And should it?
Almost certainly not. The customer placed that order and got a confirmation at the old price. You don't want to surprise them with a higher bill just because you changed your configuration months later. You need to ensure your update rules prevent automatic repricing unless a user explicitly requests it.
And what about returns? This seems like another minefield.
Returns must reference the original invoice price. If I bought a product for $100 last month and I return it today, I want $100 back, period. Even if the current selling price is now $120, or maybe it's on sale for $80.
How do you enforce that?
You use something called copy controls, specifically a setting called pricing type D or G to tell the system. When creating this return, copy the pricing elements exactly as they were on the original invoice. Do not recalculate anything.
That prevents the customer from making a profit on a return if the price went up in the meantime.
Exactly, or getting shortchanged if the price went down.
Yeah.
It maintains financial integrity.
Okay, now, inevitably, when things do go wrong, because they always will at some point, the notes point to the analysis button. This is described as the troubleshooting holy grail.
It is. It absolutely is. In the sales order, you go to the item conditions tab, and there is a button there called analysis. It shows you the entire history of the access sequence search for that item. It's like a flight recorder for pricing.
And it gives you color-coded feedback, is that right?
Yes, which makes it so easy to read. A green light next to an access means condition found. You can even click on it and see the exact table and record number that it picked.
And a red light.
The red light means condition missing. It literally tells you, I looked in table 304 for this customer and this material, but I didn't find a record. It stops you from guessing what went wrong.
And what about requirement not met? What does that mean?
That points directly back to those VOFM routines we talked about. It means the logic found a price, a record existed, but a routine like routine 2 for non-pricing items said, stop, this item isn't relevant. It's the absolute first place you should look when a price is missing or just plain wrong. If you aren't using the analysis button, you are flying blind.
We are in the home stretch now. Section 8, the danger zone. Cutover and migration, this is it. We're moving to production.
This is the moment of truth. This is when the coffee consumption in the project room goes way up.
The checklist here starts with transports.
Right. You have to move all your configuration from the development system to the live production system.
Yeah.
But there's a technical catch here. Condition tables are often what we call workbench objects. while the pricing procedures are customizing objects.
And they can be in different files.
They can be in different transport requests. You have to be meticulous and ensure everything goes into the production system together in the right order. If the procedure goes in but the table it refers to doesn't, the system will just dump. It will crash.
And once that configuration is in the live system, it's basically just an empty shell, right? There are no actual prices in there yet.
Correct. The configuration is the logic, the brain. The data is the content, the knowledge. You need to load the master data, all those VK11 records, immediately after the system is up. The notes mention using standard tools like LSMW or LTMC for a mass upload.
You can't have someone typing in 10,000 prices manually.
No, not while the business is waiting to take orders. You need a script that's tested and ready to fire the absolute moment the system comes back online.
And finally, the last big hurdle, the dilemma of open orders. This sounds like a strategic decision that the consultant has to guide the client through.
It is. The big question is, what happens to all the orders that are sitting in the system right now, created under the old logic? Option A is simple. Leave them alone.
That feels like the safest route.
It is the safest route by far. They were created on the old logic. Let them finish their life cycle on the old logic.
What's option B?
Option B is a mass update. You can use a transaction like VA05 to force a new pricing calculation on every single open order in the system.
But the expert note here warns against this pretty strongly.
It's extremely risky. It changes the net value of the order. If the price goes up, the customer might reject it. Even if the price changes by a penny, it might trigger a brand new credit check on the customer's account.
And if they're near their credit limit,
if the customer is near their credit limit, that small price increase could block the entire order. All of a sudden, shipments stop leaving the warehouse, and no one knows why. Unless the client specifically demands it and understands all the risks, you let sleeping dogs lie.
That seems like very wise advice. So, we've reached the end of the notes. The project is designed, tested, and live. And the consultant puts forward a next step to the client. It's not just, okay, I'll start building. It's something called a pricing simulation deck.
This is the pro move. This is what separates a good consultant from a great one. Instead of just promising the client it will work, the consultant says, give me 5 real-life scenarios from your sales history. Give me your messiest, most complicated orders.
The weird ones.
The weirdest ones you have. And I will walk you through, step by step, exactly how the new logic calculates the net value for each and every one of them.
So you're proving the logic on paper before you even touch the configuration keys.
And you are forcing the client to sign off on the specific outcomes. They have to look at it and say, yes, in this complicated case, we agree. We want the best price, not the stack price. It aligns expectations perfectly, and it prevents all those post-go live arguments.
So what does this all mean for us, wrapping this up?
I think it means that pricing isn't just a number. It's a language. It's a constant conversation between the business strategy and the customer, and it's being mediated by these invisible tables and access sequences. And when it works perfectly, you never even notice it. It just feels right. It feels fair.
That is the ultimate goal, isn't it? A powerful pricing model is one the customer never even notices because it just works. So the next time you look at an invoice, maybe take a second to wonder, what access sequence did I just trigger? Did I get the channel price, the customer price, or did I just fall all the way through to the global base price?
And did someone, somewhere, remember to check the exclusive box?
Let's hope so. That is it for this deep dive into the invisible architecture of SAP pricing. Thanks for listening, and we'll catch you on the next one.